Hello everyone, let me introduce our second speaker for today's webinar. Our second speaker is Mr. Maxime Fages from Singapore. Maxime is the founder of Golden Compass Quantitative Research. Maxime's career has spanned across strategic aspects of value and risk with a particular focus on trading behaviors and market microstructure over the past few years. Maxime has embraced a quantitative angle in M&A, fund management, and currently corporate strategy. Maxime holds an MSc Engineering and an MBA degree from NCR. Maxime has been a successful EPAT alumnus and has co-authored a project on development of cloud-based automated trading system with machine learning as a part of the coursework. In this presentation, Maxime will be covering futures trading, challenges of vectorized analysis, and out-of-core processing, high-frequency data for quant analysis, and more. Hi, good evening, Max. Hello, Max. Can you hear us?
Good evening. Can you hear
me?
Yeah,
good evening. Yeah, we can hear you loud and clear. So I'll just request you to take over from here, and I'll be handing over the presenter rights to you.
Okay.
Thanks a lot, Max.
You're welcome. So, screen up. Good morning or good evening, everyone, depending on where you are at the moment. Thank you very much, Deepak. That was an exciting presentation and a hard act to follow. My name is Maxime Fages. Friends call me Max, and as you can probably hear, I'm French. I'm also an alum from Quantitative, and I'm very honored to be with you tonight to share strictly personal views. As Min mentioned, I graduated last year in Quantitative. As you mentioned, the project used a stack of machine learning models to get relatively robust predictions on the short-term trends of the price signal. And then depending on the prediction, to different naive execution trading algos would be triggered, and that was hard. That was a lot of fun, and that's also not really the point of tonight. Rather, my partner at the time, Derek Wong, and I had decided to go and trade West Texas Intermediate futures, and futures is what I want to discuss with you tonight. Actually, I fell in love with futures when I was trading equities and actually trading on fundamentals. As Deepak presented, a very large stream of information will influence your views on a stock. And if, for example, you reach an intimate conviction about, say, cost management or gearing improvement for an oil company, you might see your otherwise correct prediction being countered, so to speak, by an oil shock, maybe because of a war in Libya or any other example. So at this point, shorting oil to a degree might allow you to hedge off the part of the risk you don't really have a view about. And at the time, that's exactly what I did using futures. Over the years, I've explored the asset class further, and my personal research is currently centered on market microstructure and dynamics in the future space. So tonight, I will share with you a collection of thoughts from a practitioner's point of view, and I hope to trigger your interest for the space. Today, I'll give you I hope an interest on why to look at futures. I'll discuss data about futures and some points of contention, and then I'll have some parting words on risk. So, beyond the specific risk hedging there is a lot of macroeconomic data that might have a marginal impact on individual companies or index, but they would still move markets. I have screen capped a few examples, but say GDP in the US or China, trade flows in Europe, or OPEC reports, for example, are just a couple of snippets of the vast amount of information that is available digitally and for free in a lot of cases. In fact, even if you don't have an API or XML, crawling data from official website is increasingly easy. I've mentioned Twitter feeds as well. That's also a source that is relatively easy to process. It can be processed into data frame using Python, for example. And while the IMF might not be dropping groundbreaking news very often, I'm sure we can all think of some accounts that currently do and can be traded on. Anyways, that sort of information might give you ideas about rates, foreign exchange, commodities, or really any combination thereof. That's actually the starting point for my case for futures. Futures are a promise to receive or deliver quantity of something at a given price. And at the term or expiry in futures lingo of the contract, you will either exchange physical for cash or settle the difference at the spot price. Essentially, in the case of the Western Texas Intermediate, for example, it allows you to express views on a cash market that you wouldn't necessarily have access to, except maybe if you own a few oil tankers, I suppose. It's mostly very liquid, and it's a very convenient way, again, to express views beyond, the very specific equity or index. The other interesting feature of futures is that various futures on the same underlying can trade very actively for various expiries. I really like to think of this feature the same way 2D screens compared to 3Ds, because you can know express position, bullish or bearish at different points in time. And if I give an example, typically if I think that the current oil market is in a glut but will eventually return to a higher price in the future, I can short a June 17 West Texas intermediate, which in lingo would be M7, and I go long all the way, probably all the way to 2021. We have any questions? Sorry. I'm not sure how to increase the volume, so I hope you will be able to make it work. Yeah, I was about talking about trading the curve, and if you think about rates traders, people would trade U.S. interest rates over a variety of expiries, your dollar very short term, like 2 years, 5 years, 10 years. So these rate traders very frequently put many layers of trade at the same time. Some of these combinations have fancy names like Iron Condor, and sometimes they will, have 10 or 15 different positions at different points in time for the same instrument. The other rather interesting feature for those of us in Asia particularly is that some future markets open longer hours. The Chicago Mercantile, for example, is open 23 hours a day. A lot of benchmarks are deeply and consistently liquid and tight. Bid-ask spread are fairly consistent, 23 hours a day, and it makes trading these contracts much easier on the personal life. Okay, really, the second best feature in my mind, though, is that futures are a leverage play. Since no cash or underlying is exchanged before trading out or before settlement, the broker or even the clearer and the exchange, they only need to keep enough to cover your position at any given point in time, plus a buffer that depends on volatility. So the leverage offered as a result of this, it can be really considerable, up to 20x, 30x, or even more. And there's another very interesting benefit, that is, if you're long and short on a similar commodity that tend to be the same, say gold and silver, or even on the same commodity at various expiries. You could be long December 17 on oil and short December 18. Since these things tend to move in the same direction, the total margin you will need to position your trade on two contracts is going to be less than the sum of the individual contracts requirement, and you would get even more leverage. And finally, there's no Yahoo Finance. There's no Quantopian last time I've checked. So in a way, it's data is harder to come by, but I suppose that makes it, like a less traded market maybe. Okay, I've got a specific question on OPEC production cut. I won't really. I've got a view, but I don't think that's really the topic for today. Sorry. So I've mentioned data, and I also mentioned that like data is a bit harder to come by. So I figured I would list a few ways you can get information and data. I've ranked them by descending order of price, and also to an extent of reliability. So one of the easiest ways, if you have a Bloomberg terminal, which I know is a very expensive proposition and not necessarily always the best data for everything, but it's also very frequent. They have an API that is fairly brilliant. There's an excellent package in Python, an excellent package in R, and it makes it very easy to drop whatever information you want into data frames without the annoying CSV intermediate. Another option is to buy information from the exchanges. CME is an example. MCX, SGX probably offer same services. Then if you are intending to trade across markets, you can use some data providers. I've mentioned two that I know and I've used in the past, algoseek.com and IQFeed, which basically do the same. They buy data from the exchanges, and you can tap into their API using a variety of languages, C, Python, and R. QuantDL was mentioned. There's actually a daily continuous data for futures. I'm not really sure how reliable that is. They also have like higher resolution information, so it's probably worth a try. And I mentioned the last solution, which is basically recording from your broker, because it's a way I've actually personally used. If you're using Python, for example, Interactive Brokers as an API, the package is okay documented, I would say. You can install the Interactive Brokers client on a headless server on AWS, for example, or Google Cloud or whatever service you want, and then you can basically record the market data stream, write it in HDF5, for example, in an S3 if you're using Amazon. Again, Google is your friend. It's fairly easy to find information, since I have used this information, I would like you to pay attention to one thing. If you do this, you will need to have concurrency. You will need a multi-process queue, and if you're using Python, it's slightly, well, interesting. Another question. So, Natalia, I have not used NinjaTrader. I have not used Kinetic. I have used CQG. Not sure it was called Ninja Continuum. I think the quality of data is important, and you can read reviews about this. I would say price is actually definitely a factor I would consider. Use of ease and APIs, libraries is critical, and support service. If you find something that is bizarre, it's very nice to actually have someone to reply your call and maybe go after the data. TQJ is a very valid provider, not exactly cheap either. So anyways, to resume, we were talking painful experiences, and I would like to share a few points that warrant your attention when you look at futures. The first one is, I mentioned there's expiries, so you have weird letters from H to Z, which give you months, and if you take some random contract at a given point in time, you might be not looking at the contract that is trading the most actively. So from one contract to another, really, you will have some active trading on very different things. We're currently in February. The Standard & Poor's Futures 500 would trade on the March expiry. The COMEX Gold would probably trade on the April expiry. And if you want to trade WTI, you can go very, very far in the future. I think probably 2021 at the moment. The expiry is June and December. But again, if you look at some sort of correlation or co-integration using July instead of June, you will find some very weird results. The second point is futures expire, and that means that you, if you want to get a position and keep a position in the active contract, you will need to sell into the expiring months. For example, if you're talking about SP 500, I would probably be starting to look into selling March and then buying April. And that's a topic by itself. It's actually also a very lucrative trade for some. So I won't, go too deep in this, but you should actually very much pay attention to this. And also, rolling can have a cost, so it needs to be managed. The third point is path dependent. It's actually the negative of the interesting leverage attribute of futures. You might end up being right. You might end up making a lot of money, but you might get caught by a margin call or a performance bond, as they call that at the Merck. So it is critical you pay attention to this. The result of your performance will be path dependent. A simple equity curve might not be enough. Leverage is variable, so be very mindful of this. And finally, exchange opening hours are ranging widely. So I suppose, if for people listening out of India, you could be, or actually outside of India, that are looking at prices on, say, the Dubai exchange and looking into arbitraging some US or Asian exchanges. Be very mindful of time zones. They're a bit of a nightmare actually to manage in quantitative basis. R does it fairly reliably and fairly sensibly. Python is an abomination when it comes to time zone. But regardless, I would advise you to work on UTC and frequently check your results. And also, if you're checking an exchange to another exchange, the close might be at 5 Chicago time in CME and at 5 in Dalian, China, but they're absolutely not trading at the same time. So a few questions. Can you show code examples to get data with BLP at Google? I can. Yes, I could really do that. But if you think about R or Python, again, the Bloomberg has done a fairly good job in documenting this. Maybe send a question offline. I'd be happy to share some stuff. Are you collocated as GX? No, I am not. Absolutely not. I'm not trading on SGX or on any market, so this is purely research. For backtesting. Okay, this one is Natalia, a very very interesting question. So for backtesting, how do you merge data? I mean, what do you prefer, contract expiration or X amount of day before change of volume? It's a very very interesting question. I typically use open interest for rolling contracts, but that's, like there's a variety of ways to do this. The question Natalia is asking is, if you want to study the position of your future contract on, say, the S&P 500, you will think about the front months or maybe the December expiry, but as you look back in time, the expiry you need to be looking at is not the same, and you need to merge segments of a variety of futures and a variety of expiries in one continuous position, which is actually available on Quantitative. So again, open interest would be my suggestion.
Hello, Max.
Yes?
Max, can you just take the questions after the webinar, because we are getting a lot of questions.
Okay.
But, yeah.
Sure, no problem.
Thanks a lot, Max. I appreciate that.
No problem. So I mentioned data, and it merits a special focus in my view, because as you increase frequency at tick level, really, if you can, data grows into a problem in itself. And I've tried to put an example, but a maybe easier example is the difference between being able to eyeball a spreadsheet of, say, daily close of, again, the Nifty for 5 years is going to be a bit over 1,000 points. You can really eyeball where there's a zero, a ENA, or anything. Sanity checking a 10 million lines data frame is not something you can do this way. Well, as a hint, HIST or summary are probably your friend in this case. But the bigger issue is processing data, and if you look at data, sometimes hundreds of millions of lines, knowing what to do is not enough. How to do it and how to complete the processing of data before the end of times is also needed. And it doesn't really matter how much RAM or cores you add to a server. My experience is you will eventually add more series to process simultaneously, and you will do that faster than you can add RAM or core. So out-of-core processing, which is the chunking of data in parts to be individually processed, possibly by multiple processor, is paramount and needs to be sort of at really ideation level. Another example is vectorizing. Vectorizing, to explain simply, is basically expressing any calculation for an entire data frame in a matricial form. Or to put it more simply, by transforms and combinations of columns or groups or groups of columns at the same time. So in the example of screen, I'm doing something very simple. We have a bid-ask spread to calculate. So you get the TAQ data with updates on the best bid and best ask, and at any given time index, I want to have the difference between the bid and the ask. If I loop through just a week worth of WTI data, this very simple thing will take over 5 hours, almost 6. And if I tell R or pandas that a new value is column ask minus column bid, it's just a few seconds. So to make it simple in summary, if your process starts with 4i in dimension of data frame, think again. Okay, so I hope I've triggered your interest for futures and that you will all soon come up with amazing strategies. If you do, chances are you will simultaneously have a lot of positions concurrently, because there is a remarkable potential for diversification across commodities and financials, for example. I advise you to be safe and conservative. Margin calls can be very, very painful. And when you check your risk level on the trading software on your notebook, remember something, that knowing that you have 99% chances that you won't lose more than 5% doesn't mean that you will not lose everything. Data for tail risk is scarce, but always endeavor to get a sense of what your catastrophic exposure really is. And in other words, I simply prefer CVAR over VAR, conditional value at risk, or expected shortfall whenever possible, because the mean of what you can lose in the 5% chance you exceed some sort of level of risk is actually very, very important. That slightly ominous warning aside, I will leave you with a good and general resource about futures. This is the Chicago Mercantile Exchange Group. There's data, tutorials, articles, and it's pretty easy to use. You can, of course, Google plenty of alternatives and resources on other markets, like MCX or DGCX. So if you're interested in looking, there's certainly like a lot of things you can do. To conclude, I would like to take the opportunity to salute my partner in crime and fellow alumni, Derek Wong from Beijing. We had a lot of fun since we met at Quantitative. Also, I suppose, thank you, Quantitative, as well for this and for having me tonight. And thanks to you for your attendance.
Well, algorithmic trading requires you to merge two traditionally disjoint set of skills. One is finance, another is technology. So you need to merge skills in finance and technology to be able to do algorithmic trading. So you need to understand the markets, you need to understand big data statistics to be able to design your strategies. But once you have designed the strategies, you need to also understand technology to be able to automate your strategies. So therefore, that is where the Quantitative's education programs come into place. So we train people about the entire gamut of operations and skills required to be able to be a successful algorithmic trader.